superstars, welcome to the Accounting Superstar channel. I'm Professor Don Bush. I've been teaching accounting for about 30 years, been a CPA for about that long, and I've got great ways to explain accounting. Today we're studying the cash flow statement and we are focusing on operations. And this lesson today is meant for the intermediate level accounting student. And there'll be a few little complicated things that we've got to go over, but we'll get through it and we'll make it as easy as possible. So here we go. So this is example number 2. We're using the indirect method. The people that make up accounting laws and rules and regulations, they are pushing the direct method. I don't really care for the direct method that much, but the people that make up the accounting rules, and GAAP, they say that it's okay to use the indirect method, and most people like the indirect method and use the indirect method. So here we go, the indirect method. Well, here's what we have. We've got an income statement for Fred's snowblower service, and it's ending in the year 2002. And we have a balance sheet, and we've got 2 balance sheets here side by side. We've got one for the prior year, 2001, and we have another for 2002. We also have a column here for the change that's happening. So here's what's going on. We're focusing on operations. There are 3 sections to the cash flow statement, and we are going to focus on the first category here, operations. We're not going to work on investing or financing today. So here we go. So we first look at the income statement, and the income statement, as you should know, is on the accrual basis. That is, we claim revenue when revenue is earned, and we try to match expenses with revenues. And so the income statement's on the accrual basis, but we're trying to do a cash flow statement. So we need to alter this income statement and make it onto a cash basis. So here we are. Net income was $18,100, but that's accrual basis. So what we're going to do is we're going to look through the income statement and find items that have nothing to do with cash. And in this example, there's a lot of them. For instance, we have good old depreciation expense here, $10,000. That depreciation expense has nothing to do with cash. We debit depreciation expense and credit accumulated depreciation. And likewise, amortization works the same way. Amortization expense has nothing to do with cash, so we're going to add it back to this net income. Loss on the sale of building, the loss was $20,000. So here's what's going on, folks. The loss doesn't have anything to do with cash. Cash will be recorded down in the investing section, where we will record the sale of the building, and we will record the amount of cash. But this loss is just a bookkeeping mechanism to keep our books in balance. And so this loss on sale of building, we're going to add it back, just like depreciation expense. Loss on asset impairment, the same thing. However, we've got a gain on sale of equipment, and this gain has nothing to do with cash either. Now, what we do is with non-cash expenses and losses, we add those back. With gains, we subtract them out because we're trying to get this final net income figure to reflect cash. Coming down here, we've got a few expenses that do have a lot to do with cash, so we'll leave them alone. But here's something that's rather advanced. Interest expense for $600. And normally that'd be really easy, but this interest expense also takes into account a bond premium. And the amount of the bond premium right down here, note number 1, interest expense includes amortization of bond premium amount $100 right there. And so this takes a lot of thought here. And so there's 2 ways to do it. One way is you can think it through, and that's how I do it. And it takes a while. It's not easy to think through. Or you can memorize it, okay? So, and I know memorizing's not that great, but when you're starting out, memorization's okay. So this bond premium expense, what it is doing here, now let me see if I can figure it out quickly in my head. This bond premium, what's going on is that the interest expense is lower than the amount of cash paid out. So in other words, this interest expense here, $600, doesn't reflect the full amount of cash that was paid out. So we'll see down below if I was right here, if I remember this correctly, because I know I did it correctly down below. So anyways, going on here to the balance sheet. Now cash, we're going to leave that alone more or less, but it is good to know that cash started out at $15,000 at the beginning of this year, and at the end of this year, that is 2002, it dropped down to $8,000. So there was a change in cash of negative $7,000, and this will be reflected on our cash flow statement. So that is our answer. That is what we're shooting for our answer. And if we can get that 7,000, we will know that we did this right. But what's going on here in operations? Well, we look at current assets and current liabilities. And accounts receivable was 4,000, now it's 7,000. It increased by 3,000. Now when accounts receivable increases, that means you're doing your work, you're doing your job, you're claiming the revenue, but you're not getting paid. And that is not good for cash flow to not get paid. So whenever accounts receivable goes up, cash flow goes down. Inventory is the exact same thing. Inventory was 8,000. Now it's 9,000. It went up by 1,000. So whenever you build up inventory, whenever you buy inventory, it costs you money. So when inventory goes up, cash goes down. Now, folks, all the current assets work this way. When a current asset goes up, cash goes down. So just to recap, accounts receivable went up, cash went down. Inventory went up, cash goes down. Short-term investments. Now short-term investments were 4,000 and went down to 1,000. So here the current asset is dropping. In fact, it changed by a negative 3,000. And when current assets go down, that means your cash goes up, all right? So you have to think of it this way. When a current asset goes up, cash goes down. And when a current asset goes down, cash goes up. Kind of goes in the opposite direction. And that's a good way to remember it. There's more complicated reasons that we could go into to explain all this, but I would just remember it the easy way. So prepaid expenses, let's see if you can get this right. Prepaid expenses, like prepaid insurance, prepaid rent, was 1,000 and it dropped down to 400, which means there was a decrease of $600. So whenever a current asset goes down, cash goes up. All right. Now current liabilities I think are a little easier because when they go down, cash goes down. When they go up, cash goes up. So current liabilities are a little easier to follow. So accounts payable was 8,000, now it's 11,000. It went up by 3,000. That means we're borrowing from suppliers. So whenever you borrow, that means you have more money available. Accrued expenses payable. Now accrued expenses are things like wages payable, interest payable. So it was 450, but it dropped down to 400. So it sounds like we're paying these bills. We're paying what is owed. So when a current liability goes down, your cash goes down. So cash will be going down. Taxes payable was 3,000. Now it's 2,000. Dropped by 1,000. It sounds like we're paying our taxes. And I don't know about you, but when I pay my taxes, my money goes away. So wages payable was 6,000, now it's 6,500. So the liability went up. So whenever a liability goes up, that means we're borrowing. So we borrowed in essence $500. So let's go down to the cash flow statement and I'll split the screen so we can hopefully see two things at once. Here we go. Well, here, let me show you the whole cash flow. So here's what we're going to cover. It looks like a lot, and it is a lot, but it'll help you get the hang of it. So this is what we're focusing on today, folks, the cash provided or used by operating activities. All right, so I'm going to split the screen so we can see what's going on. Okay, folks, so operations, it starts out by listing net income right off the income statement. So it doesn't take any guesswork. It's just the bottom line of the income statement. So there you go. And then we add back depreciation expense, which is right up here. Depreciation expense has nothing to do with cash, and so we're trying to get this net income on a cash basis, so we're going to add it back. So, and it's important to list it like this too. Add back depreciation expense. And I know that's a lot of writing or a lot of typing, but it's just what you have to do. We need to be very descriptive. So add back depreciation expense, $10,000. Add back amortization expense, $300. There, we get it right off of there. Add back the loss on the sale of the building, $20,000. There you go. That's a non-cash item, and we're adding it back because it's sort of like, losses and expenses. They're like cousins. They behave the same way. Add back loss on asset impairment, same deal. And then, but here, less gain on sale of equipment. When it comes to gains, we subtract those out. So one more time, we add back non-cash expenses like depreciation expense, we add back losses, but we deduct out gains. So coming down here we go. Here's that pesky interest expense. So here's what's going on. The interest expense here, the $600, was less than the amount of cash that was spent on interest. I know it sounds kind of weird, and it takes a good understanding of bonds to know why it works this way. So here we go. So $100 less amortization of bond premium. So what we have to do is we're essentially making this interest expense a little bit bigger here is what we're doing. We're putting it on a cash basis. So you can either memorize it or try to think it through. And for now, you might want to just memorize it. So you deduct out bond premiums. Guess what we're going to do to bond discounts? We are going to add them back. We don't have one in this example, but we have a bond premium deducted out. So let's go over here to the current assets. Current assets. Here we go. Accounts receivable went up. When accounts receivable goes up, that means that people are buying things, but they're just not paying you. Not good for cash flow, and so that's why we subtract $3,000. It's the change here. $3,000, we're subtracting it out. Same thing's happening with inventory. Inventory increased by $1,000, and it costs money to increase your inventory. So the rule of thumb is when a current asset goes up, cash goes down. When a current asset goes down, cash goes up. All right. So short-term investment, that went down. It went down by $3,000. So we probably sold off the short-term investment, and whenever we sell off something, we get money. So $3,000. And then here we have the prepaid expenses. Was $1,000, now it's $400. It went down by $600. Whenever a current asset goes down, cash goes up. That's what you need to remember. It always works. So add decrease in prepaid expenses. So add it back there. All right, let's go down to the liabilities, current liabilities. So we have an add increase in accounts payable, $3,000. Let's see what's going on here. So accounts payable was $8,000, now it's $11,000, went up by $3,000. Whenever liabilities go up, that means you are borrowing from somebody. And accrued expenses, this is like interest payable, wages payable, was $450, now it's $400, went down by $50. So whenever a liability goes down, that means you're paying your bills. And I don't know about you, but when I pay my bills, the money goes bye-bye. Okay, so less decrease in accounts in accrued expense payable, -50. And then less decrease in taxes payable. Sounds like we're paying our taxes. Taxes payable starts out at $3,000 and it went down to $2,000. So taxes payable dropped by $1,000. Whenever you pay your taxes, money is leaving. Add increase to wages payable. So let's see what's going on here. Wages payable was $6,000. Now it's $6,500. Looks like it went up by $500. Whenever liabilities go up, that means you are borrowing money. So it's a positive $500. Net cash provided by operations, $50,350. So I'm going to get rid of the split here. There we go. And scroll down this way here. But one thing I want to point out is that net income on the accrual basis is $18,100. We got that off the cash flow statement. And cash provided by operations is $50,350. And there is a little teeny bit of a correlation here in the fact that they are both positive, but the cash provided by operations is way higher. And it's just due to this example here, because of these non-cash transactions that happened here. These non-cash transactions lowered net income, but cash here is the amount of cash that was provided by operations. So this is a good sign for Fred here. It's positive. It's the most important number on the entire cash flow statement. That is the number one thing to look at. Now, just for the sake of completeness and repetition doesn't hurt, is we've got cash provided used by investing activities, and we're not doing this today, but if it's just to remind you that the kinds of things that go in here are like the sale of long-term assets, property, plant, and equipment, and the minus the purchase of long-term assets, property, plant, and equipment. So when we say investing activities, we mean investing in the business, investing in your business. Cash provided or used by financing activities, these are long-term debt or owner transactions, like owner investments, selling common stock, and owner withdraws. And bottom line, you get the net change in cash. By the way, this bottom line net change in cash, if we were to do the whole thing, it should say, if we do it correctly, should say negative $7,000. So the bottom line way down here should be negative $7,000. And a lot of people think that that's the most important number, but it isn't. The most important number on this cash flow statement is cash flow from operations. And why is that? Because it's the only cash flow that is sustainable. All the other cash flows are not sustainable. So there you go, folks. I hope this lesson helped. Hope you enjoyed it. Hit that like button and let me know, and I'll make some more videos for you. Until next time, over and out.